Hey, this is Diggy here from ForexHabits.com, and today we're going to do a technical analysis lesson about a profitable pattern setup that occurs in pretty much every type of chart. And when the setup occurs, there's a high probability of a breakout in the direction that I'm about to describe to you. And this is just one of the few very profitable trading setups that I like to follow. So, as the example chart, we're going to use the S&P 500 chart. This is a daily chart. Like I said, this setup will occur in pretty much all time frames on different charts, whether it be currencies, whether it be indices, whether it be individual stocks. On the chart, let's just have a look. I have a few technical indicators. I have exponential moving averages. The blue is 21, the green is 50, and the pink is the 100 exponential moving average. I have the slow stochastics indicator, and I have the RSI indicator, which is the relative strength index. Now, the pattern that I'm going to be talking about today is divergences between the price action on the chart and the RSI. Now, this is a very profitable pattern, but on the daily chart, remember that it takes a lot longer for a pattern to develop than, for example, on a 4-hour chart or a 1-hour chart. It can literally take months for a pattern like this to develop on a daily chart, weeks or months, whereas on a 4-hour chart it maybe takes a few days, maybe up to a week or 2 weeks. It's all different, but of course on a daily chart the movement will be much larger for much longer compared to on a smaller time frame. Now, the divergence that I like to talk about is that when the price action makes a lower bottom, a lower low, while the graph in the RSI makes a higher bottom, and when that occurs, there's a big chance of a huge rally happening. So, for example, this was after the crash in late 2008, early 2009, where we had that spike down, we had a rally up, even more of a spike down, total crash, where the S&P went down to, I think, 666 it was. But you can see here where the RSI was there, and here the RSI is actually slightly higher while the price action is lower, meaning that there should be a huge rally ensuing, which is exactly what happened. Actually, that was the total bottom of the situation, and it's just been going up. Now, there are many more examples that I can find in all sorts of time frames, all sorts of charts. For example, here we had this, I think this was that flash crash, I'm not really sure, where the RSI made this bottom here, and then a few weeks later we had a lower low, but the RSI, you can see, is actually slightly higher again than this bottom. And what happened? Like a big rally ensued. Same thing here in 2011. We had this kind of spike low here with the RSI being like super oversold. Then we had a bit of a rally, a bit of congestion, and again slightly lower low on the price action, but look at the RSI, much higher. So when this occurred, and you take you can imagine that there's no future chart, you don't know what's gonna happen. So at this point you look at the chart and you're like, okay, it made a lower low, but look at the RSI, it's much higher. So if this doesn't go much lower, and you can kind of take a position here, go along with just with a stop just under this low, then you can be like, okay, well, I expect a big rally, and should the downside continue, then I'm going to put my stop in and I'm not going to risk so much. So it's a very small risk for your loss compared to the potential gain of the upside if this pattern proves correct. So there's many more examples that we can find in different charts. You can have a look yourself. You can find in different time frames, whether it be hourly, whether it be 4-hourly. Just look for those divergences, and when you see one, it's a high probability that it's going to occur in this way that I've just set up. That's divergence trading. That's one of the tools that you can use to enter profitable trades. If you do it on a daily time frame, remember that your patience of the trading position you take needs to be maybe weeks, even months, that you need to hold this position. Because as you can see, for example, this low was on 9 August, and the second low was on 3 October. So that's almost 2 months for this pattern to develop, and then by the time you take the long position, before it actually plays out, that's from 3 October to actually the top, it's 27 October. So this whole setup takes 3 months and 1 month from the actual taking the position that you have to hold this. So if that's not your style, if you're more of a day trader, you're gonna have to look for these setups on like hourly charts, maybe even 15-minute charts or 4-hour charts. Depending on your style, you're gonna have to adjust it accordingly. So I hope you enjoyed that. Be sure to visit forexhabits.com, sign up via email to get these updates, to get more technical analysis lessons. Subscribe to this YouTube channel and give it a thumbs up. Cheers.